Everyone. My name is Dan Veru, Co-Chairman and Chief Investment Officer of Palisade Capital Management, and I'm very pleased to be with you from the Donahue Conference Room from our offices in Fort Lee for another timely fireside chat featuring my good friend Dan Clifton, partner and head of Washington Policy Research for Strategic Partners. Our topic this evening is an update on the major policy initiatives of the Biden agenda, including the Build Back Better legislation, corporate and individual taxes, inflation, and the outlook for financial markets as we head to the end of the year and into the next. There's a reason why this man's initials are DC. There's simply no one more qualified to discuss the Biden agenda than my fellow Jersey guy, Dan Clifton. For those who watch CNBC, Fox Business Channel, and Bloomberg, Dan is likely a very familiar face as he navigates through complex policy issues. For more than 11 years, Dan and his colleagues, Courtney Rosenberger, Jeanette Lowe, and Chris McGrath, have been the top-ranked Washington policy team on Wall Street, according to Institutional Investor magazine. Dan is also a top-ranked analyst in tax and accounting policy as well. Prior to Strategas, Dan was the director of the American Shareholders Association, a nonpartisan organization that analyzed issues facing shareholders. Dan was part of a coalition that successfully lowered capital gains to 15% in 2003 and helped institute a repatriation tax holiday for corporations and for reforms of the pension system. Prior to that, he was the federal affairs manager for Americans for two gubernatorial administrations. Now, our last fireside chat was April 23rd, and the president's approval rating was soaring at that point, and clearly was at the high point of his administration. A lot's changed in the months that we have been since we've been talking about this, and as we've moved closer to more legislation that was extremely ambitious. Also at that time, small cap stocks were at an all-time high, and it was clear that we were on a pathway to reopening the U.S. economy. But a lot of things started to change. The administration first launched its earliest discussions on what its ambitions were for the legislation that included big spending and tax increases. And Dan very appropriately raised a cautionary flag that the stimulus or candy was ending and could be replaced with higher taxes and more regulation, which he called spinach. The pathway seemed clear for swift passage of what would have been historic levels of spending, taxes, and new programs. Dan and I planned another update in August, but inflation, a messy withdrawal from Afghanistan, the Delta variant of COVID-19, and recent election losses all have eroded the president's political capital, while Democrats still have not passed the Build Back Better legislation. And Dan, I was reading your note earlier today. It seems like Democrats have a very full slate to get this legislation over the finish line. We have a lot to cover in an hour, and we're going to leave time for your questions. So Dan, the September to remember has now become the December to remember. So you're lucky you had a couple of months that rhymed, so you can make those changes. But bring us up to date on where we are and what's going to happen from here.
Well, first, Dan, let me say thank you for having me, and thank you for having me back. A lot has changed since the month of April, as you had outlined, in terms of the president's political capital, how COVID is being reviewed and or being viewed, as well as some test elections in Virginia and New Jersey, which showed that the political environment is changing as Congress embarks on a pretty historic piece of legislation. The House passed this legislation in November, so it's teed up for the Senate. And I hope tonight we could walk through the different components, what the likely outcomes are going to be, and what the roadblocks are to keep an eye on as we think about what can and cannot pass in the law. But I want to take a step back. In August, we were talking about the September to remember. because the long list of policy catalysts that Congress needed to do was the longest that I had seen in my 25 years in politics. We had the debt ceiling, we had a government shutdown, we had the reappointment possibility of the Federal Reserve chairman. The Federal Reserve was trying to figure out how to taper its asset purchases. You also had the infrastructure bill. You also had the Build Back Better bill. That is so much bandwidth that Congress cannot handle all that at once. And then, as you correctly note, we had to throw in some geopolitical risks like the Afghanistan withdrawal that was taking place at the same time, and dealing with an increase in inflation and an increase at COVID at the same time. So we had been calling it the September to Remember. And the best way that I can characterize Congress is it reminds me a lot of my freshman year in college, where students really didn't understand time management, and they would wait all the way until we got to the final exams and then start doing their work. Here we are all the way at the end of December, and Congress has now decided to do a lot of its work. And let me just say, a number of these catalysts have started to actually get done. Number one, Jay Powell's been reappointed as the Federal Reserve. Number two, the Federal Reserve is indicating that they are not only going to begin to slow down their asset purchases in the next month or so, they're probably going to accelerate those purchases. They're probably going to accelerate it. Congress has kicked the can on government funding, but we're going to prevent a government shutdown, so we're not going to have to worry about that till February. Today, the Republicans and Democrats have come together on an agreement to raise the debt ceiling and prevent a series of cuts that would have been done to healthcare providers. And at the same time, you are now starting to see the process begin for Build Back Better, and the infrastructure bill passed last month. So slowly we're reducing those items. And what it's going to do is it's going to isolate out the Build Back Better program as the final item that needs to be done. Best case scenario is that the Senate could pass something by Christmas Eve. But as we wrote in our note earlier this week, is that timeline just keeps getting pushed back as we start to go through some of these procedural issues that are going to have to be addressed. So those are all the issues that I wish to discuss with everybody tonight and really walk through in detail what the economic and investment implications are going to be of these policy outcomes. But as this first slide shows, we're calling it the December to Remember as we're starting to get through these list of issues. And hopefully we can get this resolved by the end of this month. If not, it will start to go into January. And January just doesn't rhyme with remember.
Right. Great.
Come up with something new.
Great. Yeah. So Dan, I'm going to let you go into some of the, you have some great slides to share with everybody tonight, but I tell you, you can't go anywhere without talking about inflation.
Exactly.
It's become everybody's obsession. Everybody talks about it, not just in the financial markets, but the grocery store, because it's touching everybody in a way that we haven't seen in many decades. And I'm just wondering how you view the political implications of that and what that means for some of the policies that are coming forward.
It's a great question, and it's the backdrop by which all policy issues will now be debated. And it's something that we really haven't seen since 1990, and really not something that we haven't seen on a sustained basis since the late 1970s, early 1980s. And so it's having a huge impact on the political environment. And the way that I think about how the consumer and the voter thinks about inflation is that really since the start of the pandemic, consumer confidence has been tied to what COVID was doing. So in this chart, we have a light blue. That is the percentage of the population saying COVID is a severe risk. We inverted the axis. Then we have the dark blue line, which is consumer confidence. So as more people said that COVID was a severe risk, confidence of consumers went down. And as that risk faded, confidence went up. That lasted all the way through till about June or July. And then we began to see something meaningfully happen. The number of Americans saying that COVID was a severe risk went down, but consumer confidence was not going up. For us, that was a break in what was happening on the trend. And we began to see, evidenced by this red line, more and more consumers saying that inflation is an issue. Now, think about me in July walking around Washington saying that voters are concerned about inflation. Most people didn't believe it in Washington because they live in their own little bubble. And I think it's become increasingly clear after 6 months of this that inflation is the issue that is most impacting voters. How do we know this? Last week, Federal Reserve Chairman Jerome Powell testified in front of Congress. And to watch senators who pushed for $2,000 checks at the beginning of this year saying, hey, we're worried about inflation, really was like the tipping point that inflation is the biggest issue facing the American voter. For the first time, really in 25, 30 years, you have consumers feeling the effect of inflation in various ways. Higher prices at the gasoline pump, higher prices at the grocery store, longer lines, delays in getting goods, and being told that goods are not available. All that is linked. And by the way, Dan, some of this may be temporary as supply chains start to improve, as COVID begins to wane and things come back, that you'll start to see inflation get better sometime next year. But for now, this is the defining political issue. And so if you're Senator Manchin from West Virginia and you're being asked to support a $2 trillion spending bill when the voters in West Virginia average salary is about $46,000 a year, and you're being told that your costs are going up 6% on that $46,000, that stuff is political killer issue. And so he is trying to get the size of this package down. And I'll just show you this great chart. This is the CBS News poll from 10 days ago, just 10 days ago. And what you see here is that why Americans are viewing the economy as bad, 84% are blaming inflation and 74% are blaming gasoline prices. Much more than worker shortage, much worker than unemployment, and much less than COVID restrictions. And the way that I best summarize this, Dan, is that for the first time in my political lifetime, 25 years, more voters are worried about inflation than unemployment. I've just never seen this before.
That's amazing. Yeah.
And so this is the backdrop by which this issue, this spending bill will be debated. I just want to show you one more chart, and that is that inflation is a political killer. And I just want to give context to your opening remarks. The chart on the right is President Biden's approval rating with the trend in gross domestic product, the growth rate of the U.S. economy. And what you see is that even as the economy has begun to improve again in the fourth quarter, economic growth, by the way, is really strong. President Biden's approval rating really hasn't gone up. And the reason for that is this chart on the left. It is his after-tax, after-inflation income of working Americans. And what this does is say, what did that president get in their reelection? And how fast was income growing after inflation? You see, the faster you get that after inflation income growth, the more you win re-election by as a president. Right now, after tax, after inflation income is negative year to date. And that is where the political killer comes from. And that's why Biden's numbers have come down. That's why this bill keeps getting delayed. And that's why it's hard to get political consensus on what should be included in the package overall. So to me, this is a major inflection point. Now, I want to say that low approval ratings do not by any means kill a piece of legislation at all. President Trump had a very low approval rating, very similar to where Biden is today when he passed his tax reform exactly 4 years ago. And President Obama had a very low approval rating when he passed Obamacare and even Dodd-Frank in 18 months into his administration. So at some point, you get to this belief within Congress, hey, we might lose the midterm elections anyway, so we might as well pass what we want to do. And that's why presidents have been able to get things done. It's just that this Congress is a tighter majority, 50-50 in the Senate, can only lose 3 votes in the House of Representatives. And so your margin for error is much, much smaller in this environment today.
And Dan, it didn't go unnoticed to financial markets that Chair Powell is very concerned about inflation by removing the term transitory in his testimony to Congress. So now doesn't this doubly complicate things for Congress, as they potentially you could see higher interest rates now, and certainly less liquidity in the system. That's been certainly the root of some of these inflationary pressures. But at the beginning, it's going to hurt because you're going to have less liquidity, and it'll take a while before you pierce asset pricing.
Exactly right. So let me first say that nobody in Congress wants interest rates really to go up. I mean, there may be some people who believe that inflation is a long-term threat, but the view is that they want better liquidity. And so the question here is, how do you work that balancing act? This chart here on the left is the percentage of Federal Reserve purchases of debt relative to the amount of public debt. And what this chart shows you is that on November 30th, the Fed was buying about 60% of all Treasury debt issuance at the end of November. That means the Fed was more accommodative in November of 2021 than at any point during the pandemic. Now, remember, the Fed has done this historic monetary policy because we were about to close down the entire economy. Today, about 90% of the US economy is open, and the Fed is doing more monetary policy stimulus than they were 18 months ago when we were closed. And so what's happened here is that the Fed is still providing the same level of dollars, even though there's less demand for those dollars, because a lot of the confidence restrictions that we saw at the beginning of the pandemic have begun to get resolved. And this is absolutely critical to the inflation outlook. If they don't rein this in, then there will be even more and sustained inflation moving forward. So what the Fed is basically saying is that we're going to get aggressive on monetary policy by reining in the purchasing of US Treasury and mortgage bonds. They were planning on ending this by June 30th. My guess is next week at their meeting, they will say that they're done by March 31st. Then they'll basically say, give us 3 months to rein in these purchases. That's the end of quantitative easing. Now you say, well, what's going on here? Well, the Federal Reserve Chairman is going to have to be reconfirmed as Federal Reserve for the Federal Reserve at some point, maybe even as early as 2 weeks from now. And he is going to get an earful on inflation because that is viewed as the Fed's main job, is getting inflation under control. And so now he's got something proactive and aggressive that he's doing on inflation, which really allows him to buy time on interest rates. What the Federal Reserve Chairman will be doing over the next couple of weeks is trying to separate raising interest rates from the asset purchases themselves and say we have time before we have to raise interest rates. The equity market is building in, and I would say the bond market is building in, that the Federal Reserve is going to raise interest rates 2 or 3 times next year, largely because inflation is growing so fast. And what I think the Federal Reserve Chairman is saying is, if COVID starts to retreat and the supply chains start to improve, then inflation will come in faster than expected, and then he won't have to raise interest rates. And so what I'm saying is, he's using the reduction in the asset purchases as a way to buy time so he doesn't have to raise interest rates as much, Dan. And to me, that's going to be an important test, because if inflation keeps raging, then he will be in a very uncomfortable position of having to raise interest rates in a pretty delicate economy. But if you look at 2022 overall, you are looking at a year where fiscal policy is going to slow after 2 years of very unprecedented fiscal policy, and monetary policy is going to slow after 2 years of very accommodative monetary policy. And the markets are going to have to adjust to that. And as long as policymakers are forward-looking and transparent about this, then the markets could adjust accordingly.
Right. So Dan, there's been some good things that have come out of Washington. We did get the bipartisan infrastructure bill across the finish line and signed into law. That was badly badly needed. But, you know, it seems like removal of liquidity is almost in conflict with the Build Back Better plan. You're trying to tamp inflation while throwing more logs on a blazing inferno at the same time. Could you talk a little bit about where we are right now with the infrastructure that was already passed? Is there going to be a tailwind for the economy on the bipartisan side, and then perhaps shift over to the Build Back Better initiative and what the status is of that right now?
Absolutely. I think it's important to talk about infrastructure first because it's done and it's something that, 100% guaranteed that this is going into effect. It was done on a bipartisan basis. And the reason why we don't think it's going to have a big impact on inflation is that infrastructure has a very long lag time in when that money comes out. Dan, I'm looking at the back behind you right there. You got a glimpse of our nation's infrastructure, probably better than anybody else, with that beautiful backdrop of bridges going from New Jersey into New York and the type of repairs that are needed in an aging infrastructure way. But the bureaucracy behind this takes forever to get that money out. And I worked in the New Jersey governor's office. And I saw how slow that money comes out. Rule of thumb, only about 1 out of every $4 comes out. And so what we try to do here in the red bars is outline how much money we're going to have from that bipartisan infrastructure in 2022 and 2023. And you see that they're relatively small numbers that come out during that time. And then it really starts to begin to ramp up in 2024 and 2025. And what you see here is that, it's maybe $30 billion net in 2024. That's on a $22 trillion economy. So from a macro perspective, this is not a big economic growth driver, but it is very accretive in where that money is spent. We spend about $500 billion over 5 years on infrastructure. And what this bill does is it spends $1 trillion over 5 years on infrastructure when you start to see where these places are going to be spent. So we doubled the amount of money for roads. For the first time, we're making an investment in grid spending. If we want to have all these electric vehicles, we're going to need a grid to basically hold all that up. Money for rail, broadband, $55 billion for water, and for the first time, making investments in electric vehicle charging stations. So what I think you'll start to see is that companies who are going to benefit from this spending will begin to get on their earnings calls in the next quarter or two, and they'll say, we've never seen a gusher of money like we're about to see on this. It may take 2 years to get there, but as you know, investors are forward-looking, and they'll begin to start pricing that in over time. So this is a done deal. That bill passed in the month of November, and I think it's extremely important why this bill passed into law before we talk about Build Back Better. For 3 months, this bill had been tied up in congressional gridlock. This legislation passed 3 days after the New Jersey and Virginia governor's elections that happened the first week of November. As you know, New Jersey moved 13% to the Republicans. Virginia moved 13% to the Republicans, a nearly identical shift. And I think the Democrats took away from that message that they weren't doing enough and that they were just bogged down in these process fights in Washington, and they need to be able to get their legislative agenda accomplished. By the way, there are other people who read that as you're doing way too much spending. You shouldn't do any of this. But I'm not here to say who's right or wrong. I'm just trying to give you the view from which how policymakers interpret it. And as soon as that election was over, as soon as the results were clear of what happened, the Democrats said, we better start governing. And this was the first result of that. That now leads into Build Back Better, because I think the cost of failure here would be catastrophic for the Democrats. The independent voters are leaving the Democratic Party. And so now they're saying, okay, if we fail on Build Back Better, we're going to lose the only voters that are with us, and that's our base, which is about 36% of the Democrats. So there is a real push to turn the Rubik's Cube in the next 10 days to figure out what's going on with Build Back Better. And the way that I would explain Build Back Better, because I don't read any very good news articles on Build Back Better, is that there are basically three categories of spending for Build Back Better that are going to be included in this bill. The first is an historic investment in clean energy, about $550 billion over 10 years. The second, which is important to Dan Veru, is healthcare, by ensuring that more Americans are covered with health insurance and that there's more Medicaid coverage in states that are not covered by the Obamacare Medicaid expansion, including the key states of Florida and Texas. And then third is the safety net, looking at the pandemic and saying, where were there holes in the safety net? Childcare, universal pre-K, paid family leave, and a child tax credit, which gives out $300 per child. Some people would say that's sort of a camel nose under the tent to universal basic income, but it's basically in there.
Dan, I'm sorry, I was just going to say, Dan, this is becoming, though, the incredible shrinking legislation, though. It started significantly higher. It had a lot of taxes tied to it. And it's almost unrecognizable from what you laid out last spring as the possibility for what was going to get passed or what could get passed. So, you know,
let me just say, Dan, on two fronts. There's the spending side and there's the tax side. Okay, the spending side is been cut in half, but it's been cut in half not because we changed a lot, but because instead of being 10-year spending programs, they've now been squeezed down into 3, 4, and 5 years, right? So they're playing budget games to hide the true cost of this package. And there are going to be areas where the Democrats are going to have to fight over the next 10 days. You're going to read about it in the newspaper. There's going to be a continued push by Senator Manchin from West Virginia to get this package down from 1.7 trillion below 1.5 trillion because of the inflation concerns. There's going to be a push by Senator Manchin to remove paid family leave because it's an entitlement program and we're already suffering on entitlements from Medicare and Medicaid. Why would we add a new one? The third, which you'll see in your newspapers today, is electric vehicles. Elon Musk, who runs Tesla, said, let's just get rid of the whole thing altogether. There's a huge fight going on between union-made electric vehicle makers and non-union-made electric vehicles. And my sense is the non-union electric vehicle makers are going to win this one out, given where the votes are. Then there's some fighting on immigration, drug pricing, and corporate taxes and the state and local tax deduction overall. So that's really kind of the Democrats got to get these arguments or these disagreements. They got to get them resolved in the next 10 days and then be able to put that legislation together and get it on the floor. Where you are correct, Dan, where you are 100% correct, is that this bill looks nothing like it did on the tax side as it did in the month of April. There was a near consensus in Washington, and we're extremely careful about how we do this, but there was a near consensus in Washington that the top income tax rate of 37% can easily be raised to 39.6%, and that the corporate tax rate, which is 21% today, can be lifted to 25%. And so what we show with this chart on the right is where tax law is today and what was in the House bill that was introduced on September 14th. Now, think about that, right? We talked about this in April. The House comes out with a bill in September, nearly identical to what we outlined. Higher corporate, higher multinational, higher income, higher taxes on small business, higher taxes on capital gains, and higher taxes on dividends. This is what was put out there. Is that amazing? Okay. There's only one of these taxes. There's only two of these taxes that have actually survived the political process leading into the New Jersey and Virginia races. Because there are senators from states like Arizona, Georgia, states that are not your traditional Democratic states that have Democratic senators. And those Democratic senators said, we want no corporate tax rate. We want no individual income tax rate. We want no capital gains. We want no dividend. And we're going to figure out a way to get around that and be able to finance that bill. And so what Congress did is that they've come up with a way to raise the same amount of revenue and do it on a fewer amount of taxpayers, both on the corporate and on the individual side. On the corporate side, they're moving to what's called a 15% minimum tax. Every corporation has to pay 15%. There are ways that you pay less than 15% if you do CapEx, if you have a defined benefit pension plan, if you do R&D spending or green energy credits. And so you will lose those ability to take those credits, and that is on the minimum tax rate. On the individual tax rate, they went from proposing higher taxes on about 250,000 Americans to raising taxes on 22,000 Americans. And what is being proposed is a 5% surtax on income over $10 million if you're married, and a 5% surtax on income over $5 million if you are single. That surtax goes to 8% on income over $12.5 million if you're single, and $25 million if you are married. Now, the key issue here is that if you are hit with this, if you have that income spectrum, all of your income is taxed. That means your capital gains, that means your dividends, and that means your ordinary income and your rent. They basically total it up. And so let's just say you make $30 million a year, you are going to have a 31.8% capital gains tax rate, 23.8 today, plus the 8% surtax. Your ordinary income tax rate at the federal level will go from 37% today to 45%. And so one of the coolest trends that you see happening right now is a massive pulling forward of income by the wealthiest Americans to get their income into 2021, largely so that they don't have to pay taxes on a future level. So you saw the CEO of Microsoft just sold $300 million of stock last week. You've seen Elon Musk from Tesla pull forward $10 billion of income. And what that's telling you is that the tax rates are going so high on this small proportion of population that you'll probably have a hangover in tax revenues starting in 2023 because all of that income is pulling forward. The big question that we're getting from our wealth advisory clients is what's going to happen with the estate tax. The estate tax was initially proposed to have the exemption level be cut in half from 11 million to 6.5 million. That is no longer in the bill. There was proposals to get rid of grantor trusts. That is no longer in the bill. What is in the bill is that you have an estate that produces $200,000 of income, you'll face that 5% surtax. And if you have an estate that produces $500,000 of income, you'll pay the 8% surtax. So still onerous, but very different in terms of who it hits as we move into those tax changes. So extremely different for both the corporate side and on the individual side itself. And I just want to make this one other point. I have noticed that my clients' interest in the earnings impact from this bill has begun to wane a little bit. And I want to just show you one chart. This is a chart of the S&P 500 through today's close. That's in blue. And the red is the betting odds of whether we're going to raise the corporate tax rate or not. And so there's about a 97% probability that we're not raising the corporate tax rate next year. But look at the way the red line and the blue line both moved higher in late October through early November. That was the odds of the corporate tax rate going down and the S&P 500 going higher by a couple of hundred points. Yes. Because you are taking away the earnings hit that companies would have been facing in 2022. It was about a 4% earnings hit on the S&P 500. put a 20 multiple on that, it's a couple hundred points on the S&P 500. This particularly impacts small cap companies more than it does large cap companies. And I think it positions small caps pretty well for next year. Not only did we get rid of the earnings hit for next year by delaying the tax increases into 2023 on the corporate side, but you also have fewer corporate tax rate increases in 2023 that was envisioned and 2024. So a lot of spending still in the bill. The tax side of the equation has gotten marginally better, particularly for corporate earnings. And that's why the market is like, this bill is just not as important as it was, say, on September 14th, Dan. Sorry for the long-winded answer.
Yeah, no, and of course, October, we saw one of the best months for small cap stocks of the year. All equity asset classes did well, as you rightfully point out, this reality of no higher taxes. But I remember how grim it was looking for corporate earnings with the original proposal. So again, from I think where we were to where we are now is a far better place from a corporate earnings perspective now. So Dan, we're obviously going to be talking about the new year is going to bring with us yet the start of the new political season, and we're going to be going into the midterm elections with a very different landscape for the current administration than it was perhaps 6 or 7 months ago, and certainly losses here. How, if you could basically take us through what your thoughts are from the standpoint of how the midterms could potentially shape policy, but also, what happens to the market as we see positioning. Normally the mid period of any president's time in office can oftentimes be a period of some volatility and weakness for equities. But how are you seeing it play out now?
All great questions. Let me first start off by saying that nearly every president over the last 150 years has suffered a pretty big midterm election loss in their first midterm election. There are 2 exceptions in the last 100 years, both of them in very extreme circumstances. FDR during the New Deal and George W. Bush after the 9/11 attacks. Both of them had bad economies, and they're the only 2 presidents to ever gain seats for their political party in their first midterm election. So it is extremely rare for presidents to do well in their midterm election. And the way that we think about this is that midterm elections are really referendums on a first-term president's first 2 years in office. The average number of seats that a president loses in that first midterm election is 28 seats, and the Republicans need just 5 seats to take over the majority this time around. Let me also add that that what happens here is that this is a redistricting year, and so that means the lines are redrawn in almost every congressional district in America, and the Republicans control about 43% of all the redistricting. The Democrats control about 17% of the redistricting, and nonpartisan commissions control the rest, the 40% rest. And so what you are seeing here is that the Republicans are likely going to take over the House, even if they gain no seats by elections, just by the redrawing of the seats. But the best driver of how a president's party does in a midterm election is the president's approval rating. It's a near perfect relationship between the number of seats lost and the president's approval rating. We chart it every day, and the number of seats lost are about showing up right about 43 seats today based on the president's approval rating. I just want you to know that 4 years ago, President Trump had a similar approval rating as where Biden is today. We would talk about the Republicans getting wiped out, particularly after the Virginia election. And we'd be heavily criticized by our clients saying it's 1 year away. Everybody said Trump was going to lose his election and he won his election. You really begin to see the trends, though, even though you're a year out. And these midterm elections happen in a very systemic way, or systematic is the best way to explain it. Number one, the president's approval rating falls. Number two, the party out of power gets really motivated. Biden is soft on the border, soft on inflation, soft on China and Russia, right? These are all the things that I hear coming from Republican voters and focus groups. Third is that the party in power just doesn't care as much about politics. I often joke about my neighbors in Northern Virginia, very much voted heavily for Joe Biden. They talked about politics endlessly for 4 years while Trump was president. And as soon as the election was over and Biden won, they stopped talking about politics. I'll never forget the day of the Super Bowl, and they want to talk to me about the Super Bowl. I'm like, you're back. You're done talking about all that bad stuff about Trump, right? So Democrats just become less engaged. Republicans become more motivated. And then what we saw in Virginia and New Jersey is that the independents start swinging to the party out of power, which in this case is the Republicans. And that trend usually holds between now and the election. Now, if China bombs Taiwan or Putin starts a war, that may change, okay? But we need to look at this right now and say, where are the trends headed? And it looks like the Republicans are going to take over the House, probably win 25 to 40 seats, somewhere in that range. So they'll have a sizable majority. The bigger question then becomes, does the Senate flip?
Right.
Every time the House flipped for 150 years, the Senate also flipped. 150 years has happened. President Obama stopped that in 2010. The House flipped, but the Democrats kept the Senate. 2017, Trump did the same thing President Obama did by losing the House but keeping the Senate. Okay, on paper, the Republicans should be getting wiped out in the Senate. They're defending Ohio and Pennsylvania with open seats. They have a senator in Wisconsin who's got a 25% approval rating. Florida is always going to be close, right? So the Republicans are defending more seats than Democrats. They're defending more swing states than Democrats. And yet, as you look at these political trends, the Republicans are starting to look better and better every day. If you take the New Jersey and Virginia elections and you slap that on Senate races, the Republicans will win Georgia. They'll win Arizona. They'll come close to winning Colorado. They're going to win Nevada. I mean, those are big, big shifts if that trend continues to hold. And so now the consensus, and by the way, I'm always leery when the consensus is where it is, but the consensus is that the Republicans are going to win both chambers. Okay, so that's the important context by your capital market question, which is what we care about at the end of the day. And what this chart shows you is that midterm elections have very large sell-offs, much more than you see in any other year of the 4-year presidential cycle. The average decline is about 19% in a midterm election year. On the other years, it's about a 13% decline on average. Okay, so that's a pretty significant difference. And we can go back almost 100 years with data to show this to be the case. Okay. The great thing is, it turns out to be one of the best buying opportunities I've ever seen in this business, because the S&P 500 is higher every single time 1 year later, and by an average of almost 32%. Let me just and I'm jinxing myself here when I tell you this, but the S&P 500 has not declined in the 12 months following a midterm election since 1946. Now, every time I say this, Dan, my clients come back to me and say, oh, yeah, but when the Washington football team wins the Super Bowl, stocks go up or down, right? People think this stuff is voodoo. I actually think there's a reason why you get the sharp decline and the very, very significant rebound. two major reasons on the decline. The first is that presidents understand that they're going to lose the midterm elections, and they do very anti-growth policies to try and motivate their base voters. For Trump, it was his trade war in 2018. For Obama, it was all sorts of financial regulation that crimped up capital. Biden is going to go all in on climate change. He's going to do student loan forgiveness, doing everything he can after Build Back Better passes to try and use his executive authority to get his base motivated. The second is that the market begins to worry about what happens when the party out of power becomes in power. Oh, Republicans are going to be in charge and the debt ceiling needs to be raised in early 2023. How are we going to raise the debt ceiling? Okay, so the market has to grapple with that. We're going to have less liquidity from the Fed, less liquidity from the federal government on fiscal policy, and we're going to have these midterm election year dynamics. My whole take is the equity market doesn't care who wins. They just want the election to happen because the market rallies into the election and then out of the election. You say, well, why does that happen? Because after a president gets wiped out in his midterm election, he starts to say, okay, we got to get the economy good for the next year so that I can win re-election or my party wins re-election in the presidential election year. And I'll give you this interesting stat. The year that the Federal Reserve cuts interest rates the most is the third year of a presidency. Okay? The year that they raise it the most is the first year. And so what happens is the Fed will be tightening up liquidity. Economic growth will slow from its very elevated levels today. It's called a mid-cycle slowdown. And then the market begins to anticipate that there's going to be future rate cuts and future fiscal policy stimulus. And every time I explain it, every 4 years we go through it, my clients are like, yeah. How do you do that in divided government? But they always figure out a way because the politicians love getting reelected. And so I tend to think that we're positioned for more growth and more inflation in 2022. I think we're far way away from a recession. But as the Fed begins to tighten monetary policy, and we got to go through those kind of speed bumps along the way, you've been doing this forever, so you understand them, Dan, is that as you start to go through them and you start to think about the midterm election, there could be some weakness at some point during the summer, maybe 2Q, maybe 3Q, but don't fear it. Understand there's a reason that that's happening, and it's not fatal if you're not having a recession. And that it creates a great buying opportunity, or at least has historically itself. So that's, I'm a politics guy, less of a markets guy, but we've been doing this long enough that we've seen this midterm election slowdown happen several times. And the fear in by the way, this is more pronounced in small caps than it is in large caps. And I can remember in 2014 being in a client's office and they were like, this is never going to get better. And of course, that was the day we put in the bottom in early October, and it was off to the races from there. So,
right. Yeah, I've called the Russell 2000 the reopening of the U.S. economy benchmark, and I just wonder how. I know you talk to folks like Scott Gottlieb a lot, and I saw what Dr. Fauci said earlier today with the Omicron variant of the virus. If that's as benign as some people are thinking, and of course today was an extremely strong day coupled with yesterday's rally for equities. If this really begins to unwind, or at least becomes endemic instead of a pandemic, I'm wondering what do you think?
Yes.
Politicians have weaponized this, have weaponized the virus. Some would say to their detriment. Some would say to be effective. But I'm just wondering, as that fades into the background as a political football, does that change policy at all? Does that change the center of gravity on where initiatives or where the focus is going to be? And if in fact the Republicans do take Congress back, what can the president do in his final 2 years, and what sort of policies could you think that you think he would be able to work with a Republican-led Congress on?
Yeah, let me start off with COVID, and I think there's some important trends going on in COVID that are under discussed in the news media. And so what has been happening since early October is that the number of cases, COVID cases, relative to the number of tests have been increasing. And we saw a surge over the last 2 weeks of what we call the COVID positivity testing rate. It is the single most important data point for anything related in financial markets. Because as the COVID positivity testing rate goes up, what we call the yield curve, short-term treasuries relative to long-term treasuries, begins to flatten. That's the market's way of saying we anticipate future economic growth to slow. What you start to see is that small caps underperform large caps. What you start to see is that the reopening plays begin to underperform. And what you begin to see is that technology stocks become a safe haven and energy stocks and financial stocks underperform. And so the concern last week was that surging COVID positivity rate was going to continue to go higher, up to from 10% today to 15%. And that means that there's going to be more restrictions, economic restrictions from the politicians, hospitals getting rid of elective surgeries, schools shutting down, okay? And guess what? In the last 4 days, we have had nothing but positive news on that COVID positivity testing rate. So what you have seen is that COVID positivity testing rate come down and come down significantly. And not coincidentally, over the last 2 days, the market's been open. The yield curve has steepened. Small caps have outperformed large caps. Energy is on a tear. Financials are outperforming. The reopening trade is coming back. And I think there was this fear that Thanksgiving was going to lead to COVID spread right ahead of Christmas. And now what we're seeing is that spread wasn't that great. To me, that was more important than any news you saw on Omicron. And I wish I put these charts in there. The charts are just perfectly correlated to everything going on with this COVID positivity testing rate. It's beautiful, Dan. Okay. Yeah. And this is great news.
Yeah.
Now you have two other pieces of news that you mentioned, is that Omicron, is not
Omicron. You have to be Greek to be able to pronounce it.
I was not trying to get you riled up there, but it's not as severe as they had anticipated. There was some afternoon news late this afternoon that Pfizer's vaccine is not as strong for it. So we're going to have to grapple with that. But think about what Fauci said, is that we're reconsidering the restrictions. That's what the market cares about. The market is over COVID. And if I could be controversial, the market was over COVID in mid-April 2020. Mid-April 2020. What happened was when the Delta variant came this summer, the market began to predict more economic restrictions. And so now they're saying, okay, all those economic restrictions that we were pricing in the day after Thanksgiving, because we heard about this new variant, those restrictions probably aren't going to happen. And that is helping contribute in addition to the COVID positivity testing rate. I got to tell you, in our polling, COVID is just going down and down and down and down. Americans are ready to get on with their life. Now, that's not every American. There are some people who are like, nope, zero COVID, never want to get it, not going to live the same life. And we totally understand that. Different Americans are going to have different preferences. But to watch this issue become less and less and less and less on the issue spectrum is important. Now, if that's true, and this becomes endemic, that means the supply chains are going to improve. That means that the inflation in durable goods is going to come down drastically this spring. And by the way, that's going to help Joe Biden and the Democrats minimize those midterm election losses. I actually think they're still going to lose the House and Senate, even if that happens. but then it sets up the stage for gridlock in 2023, and the weaponization of COVID will be much more difficult to do. Now, we're assuming that this isn't going to mutate and variate and continue to be with us for a longer period of time. Obviously, if that happens, that's going to have an impact. But it feels like incrementally it's getting better. And if we peak at a 10% positive COVID rate at this seasonal juncture, that's a huge victory. We were at 15 the last time we were in cold weather, and we were close to 15 in the South during the hot weather this summer. So that means that lower highs each time, and the cycle of COVID is coming down. That would be a huge event. It would be huge for small caps. It would be huge for the reopened trades. And I have seen a major sentiment reversal in investors over the last 48 hours, given the improvement that we're seeing in the COVID data.
Dan, we have a question from the field regarding the interesting question regarding the Supreme Court. I mean, they're obviously going to be hearing a lot of third rail type cases, and could the results of some of those cases have an impact on the politics?
Absolutely.
Could that, and given what's coming down the pike, any thoughts there on potentially what that impact could be?
Yes, politics is not static. We're looking at where it is today. We're also trying to forecast where we're going to be out from a year from now. And I believe that there are two big risks to the Republicans. The first is divided primaries between the Trump and non-Trump wings. You're already seeing this in the Georgia governor's race, where you're going to have a primary. There is nothing like splitting a party and then losing the election. So that's one risk for the Republicans. The second risk for the Republicans is Supreme Court rulings, and particularly somehow Roe versus Wade being thrown out. Now, when Roe versus Wade, if it is thrown out in the month of June of next year, by the way, this court ruling is going to hit the last week of June, right before the midterm election, is if it is thrown out, it's not the end game. It just allows the state legislators to then fashion their own abortion policies. And I'm telling you, state legislative races are going to be like congressional races in terms of money and impact, because that's where those decisions are going to be made. And it's longer lasting. But what's been the big change, I believe, for the Republicans in the last year is that they are doing really well with suburban voters after suburban voters turned on the Republicans, given Trump's behavior and nature. So it's been a quick reversal. You may start to lose some of that women's suburban vote that they've gained back on an abortion issue. But I sat through a briefing from the Democrats last week where they don't believe that even a ruling like this will be able to overcome the cost of living issues, and that inflation remains the largest issue, and that they have to focus on getting inflation down. If they can get inflation down, they can get voters to focus on other issues like the life issue and what that Supreme Court is going to do. So that's how it would impact the races. I don't think them in isolation can have a major impact, but if the Democrats can get everything else right, they can then use that to their advantage, assuming that that's the way the court case goes.
Great, thanks. We have another question, obviously from a taxpayer. What's the status of the SALT tax deduction? We really
can't believe I didn't bring this up. I was going so fast. Yeah. I'm so sorry, everybody.
Yeah, I can't believe I didn't either, because it's clearly it's near and dear to anybody living in New York, New Jersey, California, all the big tax states. What's your thoughts?
This is one of the biggest disagreements that's out there. The House passed legislation in November that increases the state and local tax deduction cap from $10,000 to $80,000. That means you get to deduct $80,000 of your state and local tax payment. No income limits. Anybody can do it. Now you ask why? Well, if you're in California, New Jersey, or New York, the biggest taxpayers in those states are leaving those states. And so you really don't want to have them income limited. Now you go over to the Senate. The Senate overwhelmingly wants income limits. Bernie Sanders, senator from Vermont, and Senator Bob Menendez from New Jersey did a joint press conference 3 weeks ago and said that they agree the state and local tax deduction should be capped at income somewhere between $400,000 and $550,000. And you look at that and you're like, wow, the New Jersey senator is there, even though the congressional delegation is in no income limits of the New Jersey congressional delegation, led by Josh Gottenheimer from Bergen County.
Right.
Well, there was a distinction there that nobody thought of at the time. Senator Menendez was talking about a single taxpayer at $550,000, which means that if you're married, it's $1.1 million. And Bernie Sanders was like, no, I meant $400,000 married total income. So the gap between the senators right now is like double, or more than double. And they got to figure out how to resolve that issue. The concern is that when you do a SALT deduction for people over $1 million or at $1 million, you're disproportionately skewing the tax benefit to the wealthy, which, by the way, Speaker Pelosi from California knows that. Senator Majority Leader Schumer from New York knows that. But then you get these distributional tables and says the Democrats' Build Back Better, which is designed to get income inequality under control, is one big giant tax cut to the rich. So there's a bit of a tension there of how you balance the two. My sense is that SALT will have to be in this bill for it to pass, and they are going to settle at somewhere around $600,000 of income married as the compromise agreement. And that's going to be a challenge for the House when it comes back, because the House is going to have to accept some sort of income limits overall. We'll see how that plays out. But my sense is that if you don't want SALT, or you make the change so little, you would have a lot of trouble passing the bill in the House of Representatives. And that's why I think you'll get a compromise somewhere around $600,000 of income, and you'll be able to deduct about $80,000 of your taxes if you fall below that income spectrum.
Right, and of course you touched on the key issue here. If you start cutting out the highest and the most wealthy people that are not getting the deduction, those people have the most resources to go to lower tax states, and you're going to
Exactly right.
lose those people, and you have fewer and fewer of those people supporting the tax base in the various states. Definitely creates other problems. So you could certainly see
Exactly
Gottheimer's
right.
point of view on this.
Absolutely. We're going through the greatest wealth migration in our lifetimes right now, from high tax states to low tax states. If you're in an urban area, it's not just taxes, it's crime that's creeping up in our focus groups about why people are leaving. And so if you fail to fix the state and local tax deduction to close the arbitrage between low tax and high tax states, and you put in a permanent change, as this bill is looking to do, you will accelerate the outmigration of high income residents, and you will hurt the tax base of those high income tax states. That's the tension of the debate. I do want to make one other point about this, is that if Congress is able to get this bill done by the end of this calendar year, they are likely going to make that state and local tax deduction change for calendar year 2021. The reason for that is that they want taxpayers to file their taxes in March and April of next year and be able to get a refund for their state and local tax deduction immediately, and not coincidentally right before the midterm elections.
Interesting, very interesting. Dan, if this really rolls over into the new year, that we haven't had Build Back Better, ironed out and voted on, and directionally at least heading towards the president's desk, realistically, how long can it go before it becomes unviable, where it's too close to the sun of the midterm elections, and then really nothing can get done? Understanding that failure is not an option here, but every time you hear, it's like the dike with a lot of holes. They plug one and a new one creeps open. Realistically, how far into the new year, and should we be thinking about that as the absolute best outcome for the stock market because you'll have none of the spinach. You'll only have the candy.
Yeah, so first, let me answer that last question. If this bill was to fail tomorrow, it'd be extremely bullish for risky assets like small caps and anything in equities. And that's largely because you are no longer imposing taxes on corporations. The most onerous tax in here goes into effect on January 1st, 2022. It is a 3.8% tax on small business owners over $400,000 of income. I think it's a massive growth killing tax increase. And that spinach comes before any of the perceived benefits. I believe a lot of this spending isn't really needed. It's really not growth producing. It could be needed from a social perspective, but that's different than what's good for the US economy. And that's different than what's good for corporate earnings. So if this bill goes down in flames, I think it's actually very good for stocks. I don't think if the bill passes, it's bad for stocks because much of the worst provisions have been modified and changed at this point, which means that you're just minimizing the damage of what was out there. And so, these things just don't die overnight. They hang out there, they die on a vine, and it happens slowly. What I like to say is that time is not the friend of this legislation. Let's just say in a 50-50 Senate, one Democratic senator unfortunately gets sick and cannot vote for this bill. That's what happened in 2009 in President Obama's first year when Ted Kennedy came down with unfortunate brain cancer. He passed away, and the Republicans won the special election in Massachusetts, denying the Democrats that 60th vote. That would be much more problematic today because it takes away their 50th vote, not their 60th vote. Okay. Right. And that would really just kind of imperil the bill. I don't want anything like that to happen. I'm just giving you an example, historical example. The other issue is inflation. What if inflation doesn't get better and gets worse? We're going to have an inflation reading on Friday, December 10th. My belief is that inflation is going to come in at 0.7%, which means that annualized, it would be about 6.8%, the highest rate that we've seen in over 30 years. And so now they're going to get that data point right as they're preparing to put this legislation on the floor of the Senate. You can't do that month after month after month. And what if Omicron is actually worse than we are thinking it is right now? So this bill does very little to address inflation. There's very little to address COVID, and those external events, which are harder to control, can begin to reduce the appetite for this spending bill. And so the way I talk about it, it's like a legislative piñata. The longer it's hanging out there, the more it could be whacked and then brought down by the people who are going to feel that spinach. And I'll give you this one example. Yesterday, we got a poll in Nevada, Senate race, where the Democratic senator from Nevada is losing by 3 points. She should not be losing. Okay? It's not the target race. But again, if the Virginia race is indicative, she will lose. And so now she's got to vote. She's got to decide whether she's going to vote for the electric vehicle with all those Tesla workers in there or not. She's also under attack from pharma over drug price negotiation. Get the vote now, because the longer this bill hangs out there, the more ads that are going to be run in that state, right? And so you can see how it begins to erode the support over time if you don't get this bill through. Right now, there are 48 senators who will vote for anything. There is one, the senator for Arizona, who's almost there. And there is one who we don't know what he's doing, and that's Senator Manchin from West Virginia. It is almost impossible, Dan, for the senator from West Virginia to sit there every week at the Democratic caucus meeting and prevent this legislation from passing. But what he could do is shape it to his liking and take a pound of flesh before moving forward and ultimately voting for this bill. So my point is, you want to get it done as soon as possible. When you have the votes, you take the votes. And if you leave it hanging out there, you subject yourself to risk. Now, I think about what is passed in midterm election years. Obamacare, Dodd-Frank under Obama. I think about the Department of Homeland Security under George W. Bush.
Yep.
It is not the ultimate end game, like, oh, we're close to the midterm election, we can't pass this bill, largely because you're trying to protect your base in a midterm election year. Midterm election years are base elections, and the Democratic base really want this social spending. And so the net implication of this is that the longer this goes on, the smaller the package will be to pass, but ultimately you're likely to get something done. For Hillary Care, which actually died in the legislative process, one of the few examples, it's because the bill had become too top heavy. And this bill, by removing those income tax increases and removing the corporate tax rate increases and delaying the others, created that top heaviness and moved it to the side. And so they still have some time to work through these issues on SALT, on electric vehicles, on the size of the package. But if you debate it too long, time will not be their friend.
Yep. Dan, one final question. We talk a lot here at Palisade about positioning throughout all the portfolios that we manage, whether it's our small, SMID, converts, focused equity strategies, whatever, about having the concept of having balance of growth companies versus value companies, because of all of these, because this pathway to recovery has certainly not been a linear one. We've had a lot of potholes and detours along the way that have really sort of upended it. But we could be heading to a point now where all the pieces fall into place.
Yep.
I know you're surrounded by an extraordinary team of professionals like Tom Tesouris and others who talk a lot about interest rates, and of course Jason. But I'm just curious, what would be, from your perspective, the evidence that the market is finally pricing in a global recovery, that the pandemic is endemic and these other issues have gone away? Would the yield curve be sort of the trigger for you? Would equities be the trigger for you? And as those trends kind of solidify, then you get that sort of rotation from growth to value or what have you. I'm just curious from your perspective, what would be, I know that you manage portfolios as well, and I'm just curious how you would think about it from the standpoint of positioning. I know from the standpoint of how I think about it is this balance, and when I get enough evidence, then try to keep my feet out of cement and make the shift too soon, because we could have said value was cheap last year, 2 years ago, 3 years, 4 years, whatever it was, but growth stocks just got more and more expensive. But how do you think about it from that standpoint?
So first, I think you're one of the best investors in the United States right now, and you know far more than I do about investing.
I obviously don't know very many investors because
I work with the biggest ones in the market right now, and you are as top flight of any of them. And what I would argue is that I like to look at the yield curve. The yield curve tells me a lot about what the market's expectations for future growth is. And so what we've been seeing is that every time the Federal Reserve talks about raising interest rates, the yield curve flattens, which is the way of the market saying that we don't think that you should be raising interest rates because growth is not resolved yet because of the pandemic. And so if I see the yield curve steepening while we know Jay Powell is going to raise interest rates, that is an extraordinarily powerful signal that the market is believing that economic growth is accelerating globally around the world, okay? And that the pandemic is starting to wane, that we can basically come off zero interest rates and not hurt economic growth. It doesn't say a lot when you're at zero and you think about it and you're losing, right? So that's one. Number two is, and I think, again, these, you're right, fits and starts. But number two is the value of the US dollar. In the last couple of days, you started to see the dollar weaken a little bit. And that's a
Yes.
very positive sign for me right now, because it's telling me that other economies could be getting stronger and the US doesn't have to lead the whole world and carry the world on its back, which is what we've been doing. And so when the dollar weakens, the materials, the industrial, the energy companies begin to really start to outtake on the value side, and is a necessary ingredient to get to that cyclical trade. And I think we may be at the first steps of that in the last couple of days. Again, this can all reverse on us tomorrow when we wake up and we get bad results in South Africa on the virus. But these are the indicators that we are looking for to give us the signal that the return to normality is here, or at least getting ahead of when that return to normality is here. So we know when to get into value stocks. I'm the policy guy. I'm trying to overlay policy on it. My team, as you know, are very much in the camp that 2022 will be the cyclical trade, and really start to see some of these value stocks outperform.
Great. Well, Dan, again, there's a reason why your initials are DC. You know everything about what's happening in Washington. I know of nobody who understands this material better than you do. I use it as a valuable resource when I'm trying to give guidance to my portfolio managers and analysts here, because it's really it's not the politics, it's the policies, because that's how this government allocates a lot of money, and you always want to follow the money, as you've accurately said before. Thank you so much for joining us tonight, and thank you everybody on who've been listening to this. Again, happy holidays to everybody, and thank you for participating tonight. And again, Dan, thanks for all your terrific insights and comments. Thank you.
Thank you.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.